Well, hello. Good morning, America. This is Vinney and Beau Show. We come live to you every Friday, 9:30 Pacific. I live in the Bay Area in Danville, Blackhawk, and my buddy Beau used to live in the Bay Area, and now he's in Nevada saving his taxes. I need to be more alert and intelligent and move to Nevada myself or Florida. Anyway, no. We got a great show today. And, our good friend Harper is here, Harper Jones. And how many of you have really thought about being your own bank? I mean, do you know, and most people already probably know that when you deposit money in the bank gets 11 times more money, and then they are able to pass it out, into all these different avenues to make more money. And I think that's the key factor. And Harper is going to kind of share with us all the great techniques and why it's so great thing to be your own bank and get yourself, really in a powerful situation, with that money. Beau, how are you, brother?
Doing well. Business is rocking and rolling, and it's been a good couple of weeks. I think the next like 10 days, I'm funding about 8 million in loans.
Yes.
So that's good. And then I just submitted a ground up hotel deal that's going to be a $36 million project. So the lending business is doing well right now, and actually starting to do a lot of transactions in Tennessee, which is weird because I never really did a lot of transactions. All of a sudden, there's just a bunch of craziness happening. People are going, let's invest in Tennessee. So you're getting the West Coast money is visiting you there, Harper. And then I've heard from a couple agents there that the market's just crazy because it was like a little quiet market, and now everybody kind of found the hidden gem and they're starting to invest there. So I'm sure you guys are probably.
Buddy. Yeah. John is always my great friend and partner, and John and Harper are in Knoxville, Tennessee. Beau, thank you for sharing that, man. I mean, the loans are great. We started a $50 million fund. It's a 506c, so we can talk about it with the whole world and the universe, I call it, and we have raised 9.5 million already in the first 13 days. 9.5 million. So we are very excited about it. And we're going to talk a little bit more. As you know, I am into syndication, 2 top-selling books, if anybody is interested, and we are into syndication in passively investing for our investors and all that. So let me introduce our buddy, Harper. Harper coaches people on how to practice infinite banking concept using a specially designed whole life insurance contract, becoming your own banker, and the strategy behind it, meaning you accumulate money in your life insurance contract money pool right there and deploy it simultaneously into your real estate investments. So using the insurance company's money, other people's money. I love that. OPM. Thank you, Harper. Yeah, that's what my world has been rocking and rolling with this book, the syndication, which is the same thing, OPM, right there. Vinny's always trying to show off, right? No, sorry. Using insurance company's money, other people's money, while your capital continues to compound uninterrupted, tax-free within the insurance contract. Harper, welcome, buddy. Welcome to the show.
Yeah, thanks for having me. Excited to have a good conversation and talk before we go into a great weekend.
Oh, totally. Thank you for taking the time. And everybody, please tell us where you're from. Thank you so much for joining. I know this is live in LinkedIn, YouTube, Facebook, and it becomes a podcast also later on. But please share with us, chat with us, give your name. And then also, please do let us know, where you're from. And we would love to. So thank you for joining us. We're going to continue the conversation. Ask us any questions from us, from me, Beau, John, and our guest, Harper. So thank you so much. Thank you. All right. Harper, tell us more about this concept, buddy. What is it all about in simple way?
Yeah, for sure. So it can get, real confusing and complicated as you dive into it. So I'm going to try to stay surface level. And any of you guys stop me if you think I'm going off too much of a tangent, need to bring it back. But basically, infinite banking concept is going to be a process. So when people are talking about infinite banking, they're talking about a process of banking, right? Just like a brick and mortar bank, Bank of America, Wells Fargo, how they're going to take on deposits, and then they're going to loan out someone else's money, and then they're going to profit off of that, right? They're using that leverage. And the people that are depositing that money could be, us at someone else's bank. We're going to get interest. Now, we may not get too much interest for it sitting there. And then the profits and dividends of that bank are going to go to the shareholders, the owners of that bank, right? Which is not us. Now, we can set up a similar type of bank, not like that exact bank, but a similar type of bank by setting up a whole life insurance contract and designing it, specially designing it. And so we'll put our deposits in there. Our deposits are going to grow with interest, income, tax-free, uninterrupted, 24/7, 365. And then whenever we want to use that capital, we can get a line of credit against that from the insurance company, which is someone else's money, other people's money, while our money keeps compounding within that policy, uninterrupted, tax-free, right? 24/7, 365. We'll take the other person's money, right, which is the insurance company's money, go put it to work in our cash flowing assets, right? And now we're getting both assets. We get the policy and we're getting our investments that we're using it. And so then infinite banking itself is utilizing that platform, that whole life insurance contract, and connecting both sides of the ledger, your behavior and assets and the money pool, the policy, and putting those together and flowing the money back and forth. That would be the process of banking.
Wow. How did the term come about, infinite banking? I'm just trying to learn, is it like it can keep on going till you die?
Yeah. So it's pretty cool. So Nelson Nash wrote a book, Becoming Your Own Banker, and he discovered this concept, and he dives into it in his book, Becoming Your Own Banker, which anyone who wants a copy of that, just reach out to me at createtailwind.com/Vinney, and I'll get back out to you. I'll talk with you, and I'll give you a free copy of that book. But he kind of dives into a story, so I'll let him dive into that whenever you guys read the book and read about it. But when it comes to infinite banking concept, right, you got three words. So you got infinite, you got banking, and you got concept. So banking itself is going to be the process of banking and the money flowing back and forth, as we just discussed. Concept is meaning this is conceptual. So you could look at, a policy and seeing how it's going to perform with the projections and the illustration internally, right? You got your behavior and assets, but with all of that, you don't know exactly what's going to happen, right? So you're going to plan, you're going to have it cash flow, you're going to have assets go up in appreciation. Those exact dollar amounts, the exact return, when CapEx happens, where the interest rates go up and down, there's going to change. So you got to think of it conceptually and not too specific at the numbers, right? So that would be the third word in it. But the infinite part is really, it's up to your imagination. So as you're depositing your money and you're capitalizing your banking system, and then you're ready to borrow against that, right? Well, you can go use those dollars for whatever. So you could go buy apartments, you could invest with Vinney in a syndication, right? You could go start your own real estate investing career on your own. You can use other people's money, right? Those dollars that get deposited for whatever you want, up to your imagination. But when we take those lines of credit, which is the policy loan that I'll start referring to, and go put it to work, well, we're going to want to treat that capital and pay it back to ourselves, right? So this is kind of where we're becoming our own banker, right? So then we're going to loan out that money to our entity, and then we're going to pay ourselves back with interest, and then pay back our policy loan with interest back to our policy and increase our money pool, right? And then be able to reloan and do that again and again and again. So it's infinite in the manner that you keep flowing money back and forth like that.
Oh, thank you. Wow. Go ahead, John. Yeah, buddy.
Okay, Harper. So let's kind of dive in this as from a real estate investor point of view, like where the value comes in. So, okay, if I funded this policy with, like, say, $200,000, can I then, what's the time frame before I can, or if I could actually roll into a insurance policy from another retirement account if it's eligible, maybe just like people do with IRS? Is that accurate, Harper?
Okay, so there's kind of two questions you said there. So one, the whole life insurance contract is going to be a non-qualified plan, And if you have a qualified plan, you couldn't roll those in together. I'm also not a financial advisor and don't have my licenses, so I can't advocate for someone to go liquidate an account and fund that. And you can't roll it directly over. Although this could shape up very well against, say, a qualified plan if you're using it for a passive income vehicle later in life. When you're designing the policy and getting cash in there, there's a couple ways that you could design the policy, but really it comes down to percentages of what you can access versus what you put in for different tax reasons, right? So that we want to keep it that tax-free vehicle with no restrictions. But say you get cash in there, right? So we don't have to talk about exactly how we're getting cash in there. And I can share this video that kind of dives into it with like visuals and can write it out. But let's say we get that 200 grand within the policy, right? We can borrow that, at any given time. It's 100% liquid. And we can get that within, say, a couple business days if we're getting a wire. And so then it's very liquid in that manner.
What percentage of that 200,000 is eligible to be drawn against or borrowed against?
Okay, so you can borrow up to 95% of your cash value at any given time. And the reason I say 95% is they're going to withhold, say, 1 year's interest payment.
Sure, and there's a nominal interest rate I have to pay on that capital that I borrow.
Correct. So your policy itself is going to be growing, say, at 4 or 5% uninterrupted, tax-free, depending on where interest rates are that year and where the dividends are, right? Then whenever you do borrow the capital against it, you're only paying the interest rate they're charging, which currently is 5%, for the amount of capital you're using and the amount of time that it's outstanding, right? So then you would need to pay that, say, at the policy anniversary. You don't have to pay back the policy loan. You don't have to pay back that interest to the insurance company, but think of yourself as a banker. How long would you be in business if you're making loans and no one's paying you back? So you got to have that. And you're recapturing that interest in your policy, because if you think about it, in a mutual insurance company, which is the company we would use to set up these policies, you are a part owner. You're gonna participate in the surplus profits of that company, right? There are no other shareholders except the policy holders. So even by you paying that 5% interest that goes to the insurance company, you really are kind of getting that back on a pro rata share, because that goes back to the income of the company and the surplus profits. So you want that company to be profitable.
So kind of to circle back, I'm making my $200,000 policy is accruing interest at whatever index it's tied to, whatever policy, 4, 5, 6, 7, 8%, whatever it is, right? So it's compounding and growing. I'm then leveraging by borrowing up to 95% of face value or cash value, and I'm taking that money and I'm investing in real estate because that's what I do, or whatever, right? And my returns, let's just say I'm lending the money out at 13% and I'm paying the cost of the capital is 5%, so I'm making that spread. So that's how you're kind of supercharging, where most people put it in an investment. Oh, I'm making 7% on my money. That's how your real estate investors and investors are really kind of supercharging this whole model. Is that kind of, can you give us like a real world example of what you've done or seen some of your clients do, utilizing this capital, growing it, and how it's worked out for them?
Yeah, sure. So let's look at it this way. Someone is waiting to buy a real estate deal. And as we know, real estate right now to find a good deal is very, very tough. Deals are out there, but they're tough. So people have a lot of liquidity and cash sitting right now as they're waiting for that deal. And you got to ask yourself, where's that cash sitting? A lot of people are sitting it at someone else's bank, and someone's earning interest on those dollars, or you, right? So these people will start funneling that cash, right, into a policy. And now their cash sits in that policy, earning uninterrupted income tax-free growth while they're waiting. So maybe they find a deal in 3 months, 6 months, 12 months, 18 months. But while they're waiting, that money is getting put to work within that policy at that company. And then whenever they're ready to tap into that capital, right, they'll take a policy loan and then go put it in a real estate investment. So let's say, for example, we have a client, he takes the policy loan, puts in a real estate investment, right, and puts, let's say, 100 grand to work. So now in his policy, let's say he had 200,000 in gross cash value in his policy, and let's say he borrowed against half that for 100,000 and put it to work in a real estate investment. And let's say he's making 15% once he gets the property up and running, right? Well, you're going to have the 15% the property's earning but you're going to need to pay yourself back that loan. So let's say we're also paying that back at 15%. So then you're going to pay that back to yourself at 15%, right? And then your policy is going to have that cost of capital of 5. So then you pay the 5, you have the 15 that came back to yourself. So you're going to have at the end of the year, right? You're going to have that 15,000, right? And then you're going to have the 5,000 you pay the insurance company, and then you're going to have that 10,000 difference. So you can either reinvest that 10,000, you could live off that 10,000, or you could send that back to your policy if there's enough room to expand your money pool and a cash value too, or pay down that policy loan. So there's a few different ways you can flow the money. And maybe that got a little confusing, so I can.
No, it makes total sense, Harper. What you're saying is like, we are paying our own policy 8% loan of borrowing, which is, 5% loan. I'm sorry, 5%, which is a good rate, but then we are investing it to get 18 to 20 to 30%, IRR, we call it, right? I mean, people watching us also, I don't know how many of you know us, Beau is a great loan broker and I'm syndicator, John and I. And the good part is that, we just launched a 506C fund, which is through SEC ruling. It's for accredited investors only, and only those that we can advertise, we can talk about it. The key factor is that you are able to run in real estate. You could, earn much higher returns with the cash flow and the equity gain. That's what Harper is talking about, You could be 15, 18, 20% per year when it boils down to. Yeah.
And so let's keep in mind that you may have that interest charge because it's someone else's money you're borrowing, but your money is still earning all that money income tax free, right? And that's uninterrupted compounding. And then the money that you're borrowing is just simple interest, and you control that loan totally yourself, right? So you can see where the arbitrage over time, you're going to end up, compound interest is going to be much more powerful than the simple interest, right? Then on top of that, let's say we still have that 100,000 outstanding in that property. Well, that property is going to have property taxes, insurance bill, a reserve account that you're going to be accruing, right? And that money is going to be sitting, guess where? It's someone else's bank. So if we could just divert those dollars back into our policy, we can now diminish that policy loan so that we can have less interest being charged on the outstanding policy loan just by diverting our flow of money, right? And then we can take a policy loan at the end of the year to pay for that tax bill now and then replenish it and then reloan it out again, back and forth, back and forth. So that would be another use case scenario that us and our clients are doing.
Very good. Can you kind of take us back? I know you're a younger gentleman, and John has told us that you got a decent sized rental portfolio. So I'm kind of curious on how you got into this infinitive banking concept, and then also, can you tell us about your history in real estate? How you acquired, what you do, what your kind of real estate business looks like?
Yeah, for sure. So got into real estate, I don't know, maybe it was like, say 4 or 5 years ago. Started out wholesaling. So this is where we'd find a property and we flip the paper, right? And we would make an assignment fee or we would double close the property. That helped us with less capital when we're getting started to build up capital that now we could invest. So it took about 18 months for me really to get in the right mindset that I wanted to have rentals, because I don't want to fix the toilet. I don't want to manage it. But I was too small thinking. I didn't think about outsourcing. I didn't think about building out systems. I was like, you know what? I'd rather have the check up front too. That was a younger mindset. But after about 18 months, we ended up buying a 7-unit portfolio, and then we bought a 6-unit, sixplex, and then we bought this 35-unit. And when we got the 35 unit, we needed to get about $700,000 in capital. And I believe me and my two partners brought about 150 or 200. And then we raised the 500 from people that were closer with us. And so we did kind of like a joint venture. It wasn't necessarily exactly a syndication, but it was a joint venture. And since then, we had bought that building for about $1.9 million and sold it for $2.65 million. And we had it for maybe, 14 or 15 months. So we ended up doing a full A to Z transaction with investors. That was really good to have the experience of actually closing out the deal too, and not just buying it. But since then, we bought and sold, a couple other complexes. At one point, had about 100 or so rentals with some investors, and we've sold a bunch of that. I currently still have 20 rentals with Jim and Nick, right? I think you mentioned Jim earlier, which is all on a seller finance note. So no banks involved in that. We just have a big seller finance portfolio. And then, of course, us as partners all have policies on each other as buy-sell agreements, which is pretty cool. And then I got a storage facility with my brother, and we're looking to expand holdings. We just made an offer of $3.6 million on 400 units here and around Knoxville. So hopefully we can land that or get close to landing it. So it'd be good to expand storage. So that's kind of the real estate side of things. And then a couple of years ago, we were just talking on a local real estate meetup about the 35 unit that we got $700,000 for, and just kind of doing a case study. And then afterwards, this guy came up and spoke about infinite banking. And at that, I've heard about it before, but then I was like, okay, you know what? I'm more open-minded now. I'll read the book, which is Becoming Your Own Banker by Nelson Nash. And then I dove into it and then read 5, 6, 7 other books and kept, looking around to see who the good people were. And then that's when I found Jim Oliver, who is now my partner, who we work on cases and coach people together. So I first became a client with him. And then as I just talked to friends and people about this concept, people wanted me to set up policies for them. So then I became an agent and started working at Create Tailwind. So I'm a real estate investor, and I also coach people on infinite banking and set up policies for them.
No, that's good. That's really cool. I like it. I've been interested in it. I haven't read the book yet, but I'm actually going to take you up on your offer and get the book, because it is a really cool concept.
Yeah, got it.
There it is. Yeah, that's I've always been interested in it. Is there? I know you're not a CPA or tax accountant, but at the end of the year, a lot of people might put money into their IRAs for tax purposes. Is there similar type tax purposes potentially for people that invest into their insurance policies?
Okay, so I believe I understand what you're asking. So the whole life insurance contract is going to be paid for with after-tax dollars if you're not looking at it as the business owning it and some other stuff. But I'm not going to dive into that right now. But basically, you personally own the policy, you pay your premiums, but you're going to pay the premiums with after-tax dollars. Now, you could put your money in there and then pay your tax bill by borrowing against the policy, but you're going to have to pay taxes on the dollars that you earn outside the policy, right? But once dollars are in there, all the growth within the policy will be income tax free. And then you can also later in life, we want to have cash flow and passive income. Well, when you build up a big money pool and that's all tax free in there, well, now that's going to keep compounding uninterrupted, but you could take policy loans against the policy. At that point, you don't have to pay the interest back because the policy and dividends will grow enough to pay that. So you can actually have passive income at the 0% tax bracket because it's debt against the policy, right? And live off that for decades, depending on how big you're wanting to draw from the policy. But since you're really not drawing from it and you're borrowing against it, and that keeps compounding so heavily, you can end up living off that for 10, 15, 20, 25 years, and then still pass a death benefit to your family, which also goes income tax free.
Very cool. Thank you. I've learned a lot about this. It's definitely interesting, and I see people in the comments. Yes. Looks like Bruce is giving Harper some props in the comment section. so that's great.
Howard, I'm interested in your book. Can I get a copy? Dinesh. Hi, Dinesh. Welcome. Thank you so much. I'm sure you could. Harper is a very knowledgeable guy. Great comments coming in, Harper, buddy. Look at that. And what is this question? Dinesh has a question. Does one have to form a company? That's a good question. Yeah.
Okay. Yeah. So I may go back to the bottom and go through. There's a question or two before, and then I'll work my way through the questions. So let's see here. Okay. Can anyone get this type of policy? Yeah, anyone could get this type of policy and get it set up. Everyone's situation could be a little different. So I never talk specific numbers with people and funding until they get the education part down first. So that's why you got to read the book first, and then I'll talk to you, make sure you understand the concept. And then we always do a one-on-one presentation too to dive through more specific use cases for you, and then talk, specific numbers at that point. But the answer would be, yes, there may be a few scenarios where it wouldn't be possible for that specific person because maybe they're uninsurable because this is insurance, but they could have insurable interest in a spouse, family, business partner that they could get a policy on and practice this concept.
Excellent.
And then Kurt says, what if your investment loses money and you still have to pay the money and interest back to the insurance company? So when you're thinking about your policy and this is your money pool that you're accumulating, you think of it's not an investment. That's just a place that's your warehouse of wealth and where you're storing your money. So just like if you had cash in your checking or savings account and you put it in that investment, right? If you lost money in that investment, that has nothing to do with your checking account, right? That has to do with the investment and what happened over there. So with the policy, when you're borrowing against it and you put that money to work, right? And let's say, for example, you did lose some of the money. Well, you don't have to pay that policy loan back. You don't have to pay the interest. Now, we want to at least pay the interest so that the compounding cannot be interrupted, and the interest itself won't compound on itself is really what I mean there. Then you could just take some other income to start paying that policy loan back, right? Or you could just chip down at the policy loan interest to keep that policy in force and going. So at the end of the day, I guess the moral of the story is you want to make sure you're investing with good people, or you're buying good investments and protecting your capital and not over leveraging, putting too much in the policy earlier on before it can really start compounding and offset the interest and stuff too, which goes back to the education and goes back to, specific use scenarios.
Excellent. Excellent. Thank you so much. So many people are joined today. Really appreciate that. We'll have maybe 5-7 more minutes. What if your investment loses money and you still have to pay the money and interest back to the insurance company? Well, it's our policy, right? You want to comment on that?
He did already. He already addressed that.
Yeah, that's kind of what I was thinking.
I apologize. Oh my gosh.
Yeah,
I'm behind. Sorry about that.
Another thing I will say, though, is that you're borrowing against your money, but your money is still in the policy.
Yes.
So say you lost that policy loan, those proceeds. Well, you have the policy loan payback within your cash value in the policy, right? Now, we wouldn't want to cash surrender the policy and take the cash out and make that whole. We'd want to leave it in force and keep growing and compounding it, because this is longer term thinking. We want to have that compounding not be interrupted for our whole life, right?
Sure. Excellent. One LinkedIn user says, great stuff. Thank you so much. Needed for the policy. I think Nadine is asking, what's the seasoning needed? Oh, what is the seasoning needed for the policy? Any season? Okay,
so there's a couple ways to look at this. One, and Nelson will talk about this, is a capitalization period, right? So just like if you're starting a business, building a business, investing in real estate, you're going to need cash to go do that and invest it, right? And you're going to need to make the investment to build that up. So same thing with the policy. The policy you can start using, you pay your first premium, within 30 days, you could start using 95% of that cash value that's in the policy and start banking. But the policy itself is going to take a little bit of time to really get that compounding going and the cash value to keep going, right? And this is something like when I'm talking one-on-one or you go through the book, it'll explain in more detail. But just know that you can use the cash quickly within, say, that 30 days, but it's also going to take a period of time to get that policy really, really up and running and performing like a beast.
Hey, John, will you put the link back in for the book again? Because people are asking it.
Sorry about that. Right there, buddy. In the chat, I think we had it, right, John? Maybe you can manipulate.
There it is.
Thank you so much. I'm so proud to have John with me. John is just amazing team partner and just a wonderful human being. Please reach out to us, and Beau and Harper. Thank you so much, buddy. What a great concept. And we appreciate you taking time this morning. And how can people reach you? I know we have that link, which is your company, and then /Vinney Chopra, so that people can, reach to you directly. Sure.
Yeah. So we got the createtailwind.com/Vinney, and you can fill that little form out so I can reach back out to you. You could also email me at harper@createtailwind.com. That's a good way to get a hold. I know there's a couple other questions, so if I didn't answer them, you can reach out to me and I'll get them answered.
Totally. No, thank you for all these great questions. Please reach out to Harper, and we will really thank you. Beau, any last comments, buddy, before we go?
I think John just put his comment in on LinkedIn. John is awesome. Come on, who wrote that? That might have been your dad.
Number one fan.
This is a
Uh,
love show. We love to just get together 9:30, and every Friday morning, 9:30, Vinney and Beau Show. We love doing this. And please follow us, like us. You could share this also after the episode finishes. And we also make it into podcast. So it's a show for you. Please let us know what other great personalities we can bring to the show so that we can make it really worthwhile and educational. So thank you, and we'll see you next Friday. Oh my gosh, I'll be actually in Texas on Friday. I just thought about it, John. So I'll be holding it from there if I'm not traveling. Yeah, I catch a plane in the afternoon. So I'll give the show from our Hilton Garden Inn that we purchased in McAllen, Texas, by the way. $6 million we bought it for. After COVID, it's worth 12 million. What? We'll tell you about it next week. Be sure to join because we pulled out our money, got the refinancing done. We have all money out and we own the hotel. It's amazing. It's totally amazing. So I'm going there for 3 days with my partners, and we'll see you next week. Thank you, Harper. Thank you both. Thank you, John. God bless you.